Right. Today we are going to discuss about analysis of expenses. It's also coming under uh, statement of comprehensive income. Statement of comprehensive uh, income statement. Right. Analysis of expenses. We can identify some expenses in the income statement. It may categorized as cost of sales and administrative expenses, sales and distribution expenses, and other expenses, finance cost, depreciation. We can find in income for frequent usual income statement. So that what we are going to discuss here. Analysis of expenses. An entity shall present an analysis of expenses recognized in profit or loss using a classification based on either the nature or the function within the entity, whichever provides information that is reliable and more relevant. So when prepare the income statement, profit loss account, we can find both revenue, sales or other mode of income minus expenses. These expenses are classified in different form. So these classifications of expenses can be either by the nature of the expenses or the function of the expenses. Usual income statement, we can find the expenses are classified based on the function, not in the nature. In marginal costing, you may identify the expenses, they classify the expenses based on their nature. For example, uh, material cost, labor cost, overhead cost, indirect cost. So there are so many costs we can identify, and you may find variable cost, fixed cost. So this classification of cost is based on their nature. But most of the time, when we look at the income statement, published income statement, the expenses are classified based on the function. Function mean administrative expenses, selling and distribution expenses, finance cost, such that, right? So an entity can choose the classification of expenses based on their nature or the function. But in our country, we practice what? The classification of expenses based on their function rather than nature. So anyhow, whatever the classification, that should provide more information that is reliable and more relevant. Our point of view, us, most of our people perceive that provide information of expenses will give more information when they classify the expenses based on their functions. So entities are encouraged to present the analysis in paragraph 99 in the statement of comprehensive income or in the separate income statement if presented. So yesterday we have discussed there are two ways of presenting in comprehensive income. So one is single statement, another one is single statement plus profit loss account plus other comprehensive income. So expenses are subclassified to highlight components of financial performance that may differ in terms of frequency, potential for gain or loss, and predictability. So this analysis is provided in one of two forms. That is a nature of expense method, function of expense, or cost of sales method. So the second one is the most frequently used method. Let us discuss the first part, that is the nature of expenses method. An entity aggregates expenses within profit or loss according to the nature. For example, depreciation, purchase of material, transport cost, employee benefit and advertisement cost, and does not reallocate them among functions within the entity. So this kind of classification of expenses we can find in marginal costing, management accounting, ABC analysis, relevant cost analysis, CVP analysis, where the nature of expense method is more appropriate. But anyhow, LKAS 1 is not prohibit to classify the expenses based on their nature of expenses. If management decides that the nature of expenses, classification of expenses based on their nature gives more information, more reliable information, then they can go for nature of expenses. So this method may be simple to apply because no allocation of expenses to functional classifications are necessary. An example of classification using the nature of expense method is as follows: revenue, other income, changes in inventories of finished goods and work in progress. It's like opening stock minus closing stocks, right? So raw material and consumable use, material cost, employee cost, and other overheads, depreciation and amortization expenses, and other expenses. So total revenue, total income minus other expenses equal profit before tax, right? So this is one way of classification of expenses. It's nature, based on their nature. Now we move to the second method of classifying, analyzing the expenses. Function of expense or cost of sales method. So this approach classifies expenses according to their functions as part of cost of sales, or for example, the cost of distribution, selling and distribution expenses, administrative expenses, like that. At a minimum, an entity disclose its cost of sales under this method separately from other expenses. When we look at the income statement, we can find most of the time at the top of the income statement revenue, after that cost of sales, then we'll get a gross profit. So this method can provide more relevant information to users than the classification of expenses by nature. But allocating cost to functions may require arbitrary allocations and involve considerable judgment. An example of classification using the function of expenses method as follows. So we can find this method in most of the annual report in financial statement. Revenue minus cost of sales, then we get gross profit, and plus other income minus the distribution cost, admin cost, other expenses, then we'll get profit before tax. So when we compare the function of expenses and the nature of expenses classification, the function of expenses will give more detailed one. The choice between the function of expense method and nature of expense method. An entity classifying expenses by function shall disclose additional information on the nature of expense, including depreciation and amortization expenses and employee benefits. So when we look at the uh, income statement that was prepared based on their nature of expenses, it will give more information. It's been in detailed informations, but that information may not relevant for external stakeholders. But when in the point of management, so that classification is more meaningful and more relevant. The choice between the function of expense method and the nature of expense method depends on historical and industry factors and the nature of the entity. uh, the nature of the business when we take into consider, when you look at the income statement of manufacturing companies and banking industries, financial sector, their income statement is totally different. The way of presenting income statement is totally different. When you look at the bank's financial statement, you may find interest income, interest expenses, right, and other auxiliary sales income. So there are uh, different types of classification of expenses. So it's because of the nature, because of the industry of the entity. Both methods provide an indication of those costs that might vary directly or indirectly with the level of sales or production of the entity, because each method of presentation has merit for different types of entities. This standard requires management to select the presentation that is reliable and more relevant. If the management of the entity perceive that classify the expenses based on their nature will give more information, more relevant information by the users, then they can opt for classification of expenses based on their nature method. However, because the information on the nature of expense is useful in predicting the future cash flows, additional disclosure is required when the function of the expenses classification is used. So when you look at the cash flow statement, you can find two types of statement: direct method and indirect method. So when you look at the direct method of cash flow statement, you may find uh, uh, they classify the cost in the way of the nature, not the functions. So how much paid for material, how much paid for labors, how much paid for the transportation. So that kind of classification we may find. So it will give more information. So when the cost classifies based on their nature, it will give more detailed information about the movement of cash. Now we move to the second part of the income statement, that is not third so, statement of changes in equity, not cash flow statement. It's a change statement of changes in equity, how the ownership is changed over time during the period, whether they have earned more profit, or they have encountered loss, or they have declared dividend or right issue, bonus issue, share any other share issues, share repurchase. So that kind of movements we can understand. Here we can find a consolidated in the statement of changes in equity. You may find the opening balance, profit for the year, right? Return profit, profit for the year, and other comprehensive income, right? Here they have find loss and total comprehensive income for the period, and issue of share capital, right issue they have made, a new issue, right, and other equity movement in subsidiaries in case of controlling interest and non-controlling interest. So it's in case of holding company, group of companies. So here they have compared 2 years, right? Um, so for the purpose of comparability, most of the time organizations, entities are present uh, 2 years, current period and current period and previous period statements. So this is the statement of changes in equity. An entity shall present a statement of changes in equity showing the statement a total comprehensive income for the period, showing separately the total amount attributable to the owners of the parent and non-controlling interest. Here you can find the profit for the period. This belongs to the non-controlling minority interest and uh, controlling body. For each component of equity, the effect of retrospective application or retrospective restatement recognized in accordance with LKAS 8. LKAS 8 means what? Rectification of error, events after the balance. Changes in accounting policies, LKAS 8. Changes in accounting policies. So here retrospect retrospective means what? A self-assessment, right? It's kind of self-evaluations uh, when they prepare the statement of changes in equity, and there are some events due to changes in accounting policies. In that instances, they have to make some adjustment on statement of changes in equity. So that should be reflected here. So they have to follow LKS 8. For each component of equity, reconciliation between the carrying amount at the beginning and the end of the period, separately disclosing changes resulting from profit. So the profit or loss may impact on ownership equity, each item of other comprehensive income, and transaction with owners. So share issues or share repurchase, dividend, right? A transaction with owners in their capacity as owners, showing separately contribution by the contribution. It's mean shares, new share issues, and distribution to owners. It's mean in the way of dividend, and changes in ownership interest, minority interest, and controlling interest, like that. Interest in subsidiaries that do not result in loss of control. You may find here, right? All of things you can find here. So it's kind of reconciliation. No, you see the figures in the beginning of the period, and you can find here the figures at end of the period. So in between you can find uh, reconciliation. An entity shall present either the statement of changes in equity or in notes, right? In notes also they can give that information about the changes in equity. The amount of dividend recognized as distribution to the owners during the period and related amount per share, related dividend per share, DPS. In the paragraph 106, the components of equity include, for example, each class of contributed equity, the accumulated balance of each class of other comprehensive income, and retained earnings. Changes in an entity's equity between the beginning and the end of the reporting period reflects the increase or decreases in its net assets during the period. When you see here, so you can find the beginning balance and you can find ending balance. So you may observe there's an increase in their equity balance. The increases arises due to what? Here, return profit. So earlier it was loss, and profit for the year this amount, right? And new issues, right issues, and also share premium has reduced here. Then we have received this amount. Changes changes in an entity's equity between the beginning and the ending of the reporting period reflect the increase or decrease in its net assets during the period, except for changes resulting from transaction with owners in their capacity as owner and transaction costs directly related to such transactions. The overall changes in equity during the period represent the total amount of income and expense, including gain and losses generated by the entity's activities during the period. So, in simple term, we can say this paragraph like this: when the in the absence of new contribution of capital, equity capital by the owners, or any withdrawals or dividend distributions. So in absence of these two, any increase or decrease or any changes, the balance of equity between the beginning period and the ending period is arises due to income, so profit or loss from the normal course of business, or other comprehensive income, right? Other activities. LKS 8 requires retrospective adjustments to affect the changes in accounting policies. LKS 8, to the extent practicable, except then the transition provision in another standard require otherwise. LKS 8 also requires restatement to correct errors to be made retrospectively to the extent practicable. So they have to make an self-evaluation on their statement of changes in inequity. So it is based on the LKS 8, that is a statement of changes in equity, changes in accounting policies. So retrospective adjustments, it means self-evaluation adjustments, and retrospective restatement are not changes in equity, but they are adjustment to the opening balance of the retained earning, right? Most of the time they do make changes in retained earning, except when the standard requires retrospective adjustments of another component of equity. The paragraph 106b requires disclosure in the statement of changes in equity of total adjustments to each component of equity resulting from changes in accounting policies and separately from correction of errors. These adjustments are disclosed for each prior period and the beginning of each period. Simply, they will make adjustments on the retained earnings. Now we move to the next statement, that is what? Statement of cash flows. It's very simple. We have standard alone chapter in our course. Uh, LKE 7, we will discuss in detail about the statement of cash flows. We have some calculations. Cash flow information provides users of financial statement with the basis to assess the ability of the entities to generate cash and cash equivalent, and the need of the entities to utilize those cash flows. So in simple terms, uh, in the statement of cash flow, we can observe how entity generate profit, generate money, and how the entity spend the money, cash inflow and cash outflow. LKS 7 set out the requirement for the presentation and disclosure of cash flow information. And we move to the next area, that's notes. Right? The fifth one, notes. The note in the annual report, you can find the notes. If you want, I can show you one statement, right? Yeah, and reports. Right. So this is the annual financial statement. Is So this is statement of comprehensive income. You can find the term not, right? Not. So they have numbers, right? The numbers. So when you look at the number 5, that is relevant to other income. So it's a notes, right? So when you look at the 5, number 5, right here, other income. So you can find interest income and sundry expenses, the detailed one, right? These are the notes. Right? The notes shall number A, the present information about the basis of preparation of financial statement and the specific accounting policies used in accordance with paragraph 107 to 124, and disclose the information required by Sri Lanka financial reporting standards that is not presented elsewhere in the financial statement. So they should not repeat the information. If the information is disclosed in somewhere else, like, so if the information is disclosed in the income statement or the balance sheet or cash flow statement, they don't want to repeat that again. So the purpose of the use of notes is to give informations that was or that were not already disclosed in the statements. The provide information that is not presented elsewhere in the financial statement, but is relevant to an understanding of any of them. An entity shall, as far as practicable, present notes in a systematic manner. An entity shall cross-reference each item in the statements of financial position and comprehensive income in a separate income statement and in the statement of changes in equity and of cash flows to any related information in the notes. In simple terms, the note should be used to provide additional information that is relevant. That information is not disclosed in other statements. An entity normally present notes in the following order to assist users to understand the financial statement and to compare them with financial statement of other entities. Statement of compliance, statement of compliance to laws and regulations, especially Sri Lankan Financial Reporting Standard is the compliance. Statement of compliance with SLFRS. Summary of significant accounting policies applied. So if there are any changes in accounting policies, so that should be also disclosed in the note. Support information for the items presented in the statement of financial position and comprehensive income, separate income statement, and statement of changes in equity and cash flows. In other words, in order in which the statement and each line item is presented. Other disclosures including contingent liabilities and unrecognized contractual commitments, and non-financial disclosure, example entities financial risk management objective and policies. So disclosure of accounting policies. Now we uh, still we are in the note, a special section under notice disclosure of accounting policies in the note. So they have to disclose any changes in accounting policies. An entity shall disclose in the summary of significant accounting policies the measurement basis or basis used in preparing the financial statement. For example, earlier they have used a historical method to value the assets, value the machineries, value the furnitures. But now in the current period, the management decides to value such assets in revaluation, market value method. So this is the changes in accounting policy. And in case of depreciation, earlier they have used straight line method. Now in the current period, they are going to switch to reducing balance method. So this is also changes in accounting policies. So such information is if significant, it should be disclosed in their note. The measurement basis used in preparing the financial statement or other accounting policies used that are relevant to an understanding of financial statement. It is important for an entity to inform the users of the measurement basis or basis used in the financial statement. For example, historical cost, current cost, net realizable value, fair value, or recoverable amount, because the basis on which the entity prepares the financial statement significantly affect users' analysis. When an entity uses more than one measurement basis in the financial statement, for example, when particular classes of assets are revalued, it is sufficient to provide an indication of the categories of the assets and liabilities to which each measurement basis is applied. In deciding whether a particular accounting policy should be disclosed, management considers whether disclosure would assist users in understanding how the transaction, other events, and conditions are reflected in reported financial performance and financial position. So, in the note, before they disclose, they have to make judgment whether do the entity need to disclose these changes in accounting policy or not. So how they can decide if the changes in accounting policy impact on the users of financial statement, definitely they have to disclose. If it is not material, if the information is not much useful for the users, then they no need to disclose in the notes. Disclosure of a particular accounting policies is especially useful to the users when those policies are selected from alternative allowed in SLFRS. So there are different methods, alternative methods available in the standard. So when they choose one among others, they have to give some notes. An example is disclosure of whether a venturer recognizes in its interest in a jointly controlled entity using proportionate consolidation or the equity method. LKS 31 interest in the joint ventures. You may study it about joint ventures, associates, subsidiaries, holding companies under the different standard in your previous year. Some SLFRS especially require disclosure of particular accounting policies, including choices made by management between different policies they allow. For example, LKS 16 requires disclosure of measurement basis used for class of property, plant equipment. So when you look at the PPE, you can observe so many class of assets, furniture, machineries, and fixtures, motor vehicles, lorry. So there are different class of items. One class of item may use a market value method. So another class of item is measured on historical cost basis. In such case, the management should disclose such information. Each entity considers the nature of its operations and policies that the users of its financial statements would expect to be disclosed for that type of entity. Normally, management knows what the users are expect from the entity's financial statements. So that information they should disclose. For example, users would expect an entity subject to income taxes to disclose its accounting policies for income taxes, including those applicable to deferred tax liabilities and assets. When an entity has significant foreign operations or transaction in foreign currencies, users would expect disclosure of accounting policies for recognition of foreign exchange gains and losses, etc. An accounting policy may be significant because the nature of the entity's operations, even if amount of current and previous period are not material, right? So it's also appropriate to disclose each significant accounting policy that is not specially required by SLFRS, but the entity selects and applies in accordance with LKAS 8, that is changes in accounting policy. An entity shall disclose in a summary of significant accounting policies or other notes the judgment apart from those involving estimations that management has made in the process of applying the entity's accounting policies that have the most significant effect on the amounts recognized in the financial statements. So in the process of applying the entity's accounting policies, management makes various judgments apart from those involving estimations that can significantly affect the amount it recognizes in the financial statement. For example, management makes judgment sometimes in regarding the disclosure of other information, especially changes in accounting policies. So not all the times management need to disclose such changes. The management have to decide whether such information should be disclosed or not. So it's the decision is simply based on one criteria. Is what? Whether if the information is helpful, the information is relevant, the information is relevant to the user of financial statement to take decisions. When they hide that information, the decision may be differ. So in such circumstances, so they have to think about that circumstances and then they decide. And also management knows what normally what shareholders or other stakeholders expect from the entity regarding the finance information. So that information also decide. Right. Management make judgment in determining whether financial assets, financial assets include what, debentures, in fixed deposit certificates, and shares in other organizations, other companies, or other interest bearing investments. Whether financial assets are held to maturity investments, when substantially all significant risk and rewards of ownership of financial assets, and these assets are transferred to other entities, whether substance particular sale of goods are financing arrangement and therefore do not give rise to revenue, whether substance of relationship between the entity and the special purpose entity indicates that the entity control the special purpose entity. Source of estimation and uncertainty. So some estimation management should take, for example, regarding the provision for bad debt. Provision for bad debt. It's kind of estimations. It's kind of estimation. We may expect that 5% of our customers will not repay our money. But when in practice, at the time comes, actually 20% of the debtors not pay. So earlier they expect 1% or 2%. Now the actual amount is 20%. So there are some errors, uncertainty on the estimations. Or the company, the entity purchase a land for the purpose of resale as an investment asset. So they estimate in the next year the price of the land may be increased by 10 million. But actually the price is not appreciated, increased as they estimated. So these are the risk. So these are the sources of estimation uncertainty. Estimation uncertainty, not sure about the estimation. An entity shall disclose information about the assumptions it makes about the future. And other major source of estimation uncertainty at the end of reporting period that have a significant risk of resulting in a material adjustment to the carrying amount of assets and liabilities within the next financial year. In respect of those assets and liabilities, the note shall be include details of the nature and their carrying amount as at end of the reporting period. Determining the carrying amount of some assets and liabilities requires estimation of the effect of uncertain future events on those assets and liabilities at end of the reporting period. For example, in the absence of recently observed market prices, for assets, sometimes we estimate the market prices. Future-oriented estimates are necessary to measure the recoverable amount of class of property, plant, equipment, the effect of technological obsolescence on inventories, right? Obsolescence on inventories, due to technological changes, some inventories become valueless. Already an entity estimate the inventories on FIFO method or LIFO method, so whatever the method, they have given a value. But suddenly, sometimes the inventories have valueless items due to the technological changes. So obsolescence of inventories and provision subject to the future outcome, litigation in progress. There are some court cases and long-term employee benefit liabilities such as pension obligations. So these estimates involves assumptions about such items as the risk adjustment to cash flows or discount rates, or future changes in salaries and future changes in price affecting other things. Estimation, right? Source of estimation uncertainty. And an entity presents the disclosure in paragraph 125 in a manner that helps user of the financial statement to understand the judgment that management makes about the future and about other source of estimate uncertainty. The nature and extent of information provided vary according to the nature of the assumption and other circumstances. Example of the types of disclosure: entity makes the nature of assumption or the estimation uncertainty, the sensitivity of carrying amount to the methods, assumptions, and estimates until underlying their calculations,